fundamentals are in the U.S. economy is still very constructive. I think the Q4 sell-off was overdone. Equity markets was pricing both an earnings recession and outright GDP recession, and I don't think that's correct, and that's an out-course scenario. So we're expecting volatility to come in this year versus the highs we saw last quarter. But at the same time, we're highlighting higher volatility, which is just a technical term saying there's elevated tail risk in the market, whether we're talking about trade or geopolitics. So that, I think, lines up with what Larry was saying.
Troy, that is what Larry was concerned about, any potential situations on the geopolitical front that we just don't know the answers to yet.
Well, yeah, so it's very hard to predict the outcome of Brexit. Obviously, Europe's in somewhat of a slow-motion train wreck between the French yellow vests and the budget shenanigans in Italy. From our perspective, it's all about the U.S. economy still remaining strong. We know it's going to slow down this year, but we're looking at potentially 2.5%. And it's deja vu all over again. This is very similar to the 15-16 sell-off, right, where all it takes is a Fed not doing anything to cause markets to rebound. And so far what they've done this year is chill out, and they're messaging that very well. And we think the biggest news yesterday was not Brexit. It was Esther George, who's an Uber hawk, coming out very dovish. That's a very powerful message from the Fed that they get it, they're going to chill out, and they're going to allow markets to stabilize.
So do you like U.S. stocks compared to the rest of the globe?
Oh, for sure. I mean, if you're concerned about risk reward, you still want to be in the U.S., right? There is the potential, though, for emerging markets to have a strong year after a disaster last year.
Because of the dollar?
Yeah, because if the Fed stays easy, let's say they don't hike at all this year and they slow down the pace of winding down the balance sheet, then the dollar weakens 5, 6, 7%, and you get a similar outcome to what you had in 17. So if you're all about greed, that's not a bad place to be. But if you're focused on risk reward, we still think the U.S. is the best place to be.
Mandy, the other thing that Larry said is that, investors are much more willing to pause right now because you can park your money in a money market and get 3%. That is a different scenario than what we've seen over the last 10 years.
Yes, so I think part of what drove last quarter's price action was investors de-risking, right? We saw hedge funds, institutional investors take risk off the book going into year end, and as a result, we saw very little demand for hedging in the options market. I think that lines up with just lack of conviction going into and taking risk off going to the end of the year. But now the question is, at the start of the year, we just had a 10% rally. At what point do you feel you have to get back in, right? I think we could have a chase to the upside.
You should have gotten in 10% ago, right?
Exactly. Well, exactly. But as markets keep going up and as earnings come in better than expected, you have to chase.
Troy, do you have conviction that putting your money in U.S. stocks right now is going to be better by the end of the year than putting your money in a money market at 3%?
Yeah, we'd be surprised if equities don't make new highs, right? And for us, quite frankly, coming into the year, we thought we could potentially retest the lows of December 24th. But the clear signal the first week to us was credit spreads stabilizing. So first they stabilized, and now they've ripped in. If you look at high yield, it's done extremely well. Levered loans are up over 3% this year. So that's a tremendous January effect. And so basically what it's telling you is markets de-risked. Multiples, risk premium adjusted to the Fed tightening, winding down the balance sheet and hiking 4 times last year. And now you're finding footing at slightly higher multiples and slightly tighter spreads. That doesn't mean you're going to have a rip-roaring year like 17, but it would shock us if we've seen the highs for this bull market.
So what do you tell people to do specifically?
Well, for our portfolios, we're very focused on risk reward. So we're trying to make high single digits. And we think right now the U.S. consumer is in exceptional shape. Virtually every metric you look at, financial obligation ratios, debt service, debt to GDP, et cetera, tell you that you're going to have a high single digit return in consumer-focused credit. And if we're wrong, and if we actually do have a recession that starts in early 2020, markets start to price that in the later half of the year, well, then we'll have far less downside in that scenario than, say, equities or high yield. So we're shooting for a high single-digit return with much less downside if we're wrong and things go south.
What are you watching to see if we are potentially moving towards a recession? What are the most important?
Well, we've been super focused on the Fed and Fed language, right? Because Jay Powell and Quarles both came out in Q3 and said, look, we're not here to act as a Fed put, right? The Fed put days are over. They've now walked that back. We've talked about some of that. They're clearly going to be a little less aggressive. So that's
but they're more concerned about the economy. So what makes you feel good about that scenario?
Well, so look, part of what affects the economy is financial conditions, right? And they wanted financial conditions to tighten, and they did, but they arguably tightened far too much. So that will have an impact on economic growth. We are going to have slower growth. So if they go slower, what that basically means is that you can have marginally higher growth this year. And so back to the point, focused on the Fed, but also focused on business fixed investment, right? Because business fixed investment was going to be lower this year than last year either way.
Right.
Now it's arguably even lower because oil's fallen so much. But in order to get sustainable 2 to 2.5% growth, you need to see around 6% business fixed investment growth. We were well above that in Q1 and Q2. We dropped down in Q3 and Q4. How much of that's trade, how much of that's tightening financial conditions, hard to see. But that's another data point we're hyper focused on.